Hello and welcome to Forex.Academy, your #1 website for Forex and crypto education and analysis. In today's edition, we're going to be discussing how synchronized indicators equals more winning trades. A little bit of care and patience will enhance your trading. One area where new traders fall down is because they have a system but do not stick to it. And one of the most common traits is using indicators in a haphazard way, so to set up a trade to fail. Let's look at example 1, which is a 1-hour chart of the USD JPY pair for some examples. In this chart, we are using two commonly used indicators, the stochastic oscillator and the moving average convergence divergence, or the MACD indicator. For a brief recap, the stochastic indicator tells us when an asset is overbought or when the two moving averages cross above the 80 level, and when they move beneath the 20 level, the asset is considered to be oversold. The MACD uses one or two moving averages. In our case, we are using one, and subsequently rising towards and then through and above the zero axis, it is considered to indicate that the asset should be moved higher, and especially if it is supported and almost mirroring the histogram, which is the second component of the MACD. The opposite action applies to the descending asset. At position A, we have drawn a vertical line which shows us the stochastic is suggesting that the pair is overbought and due for a move lower. However, the MACD is moving higher, and thus not working in unison with the stochastic, and with the MACD's moving average is going up and above the zero axis, and the histogram is following suit, having come from underneath, to move above the zero axis also. In this scenario, price action has ignored the stochastic and moved higher. Here our indicators are at odds with each other. Selling this pair based on only the stochastic indicator would have resulted in a losing trade. At position B, the stochastic is moving up, having been below the 20 line, and on this occasion the MACD histogram is moving underneath its zero axis and now higher, having pierced through the moving average, which is an indication that divergence is occurring, and indeed the price action does move higher from this point. Here our indicators are synchronized, and the payoff is that buying the pair based on both of these indicators would have been rewarded with a positive winning outcome. Position C is similar to position A in that our stochastic is suggesting that the pair is overbought and due for a move lower, and with the MACD histogram is starting to move higher. This is quickly followed by the moving average, and if we had gone short at this point we would have entered a losing trade. At position D, our stochastic is showing that the pair is oversold, and our MACD is showing that the pair is due to fall lower, and where we can see a slight move lower in price action, before the reversal. Again, we have seen a mixed message from our indicators, and where we can see from our charts that when our indicators are working on a synchronized basis, they throw up more winning trades than losers. Be patient and wait for your chart indicators to be synchronized, and keep an eye on the price action. This is the most important indicator of all, and where all of your indicators are working together, only then should you be thinking to pull the trigger on a trade. If you enjoyed the video, then please like and subscribe, and leave a comment down below about anything you would like us to discuss in future, or if you have any questions about this particular video. Have a great day.